qualified business income deduction has effectively been included in tax reform, which effectively has provided significant tax benefits to our real estate owner-operated developers. Most of you know that the press has given a lot of attention to the cut in the corporate income tax rate, which has gone from effectively 30% to 21%, and the impact to the corporate A&T being repealed. We're going to go into the specifics and the computations as it pertains to the corporate business tax deduction. Individual taxpayers will be able to deduct 20% of their domestic qualified business income through pass-through entities, including but not limited to partnerships, LLCs, S corporations. There is a limitation based on wages paid and wages paid plus a capital component, and there is a phase-out for taxable income above a threshold amount. The deduction is allowed for certain service trades or businesses, but that limitation will be phased out for incomes above $415,000 for married filing joint taxpayers. As we turn to the specifics of the tax deduction, this pass-through deduction will apply for tax years beginning this year, 2018, through and including 2025. The 20% deduction will be allowed for trusts and estates that have an interest in the flow-through trade or business. The qualified business income deduction is determined for each qualified trade or business of the individual taxpayer. For any taxable year, the qualified business income is the net amount of all qualified items of income, gain, deduction, or loss with respect to the qualified trade or business. The determination of the qualified items of income, gain, deduction, or loss considers these items only to the extent included or allowed in the determination of taxable income for that tax year. As with everything with regards to tax, there are exceptions, including exceptions to exceptions. On the exceptions, we have items considered in determining net capital gains or losses, which would be excluded. Dividends, including income equivalents to a dividend or a payment in lieu of dividend, will be excluded. Interest income, other than which is properly allocated to a trade or business, is excluded. Qualified items under the provision does include any item of gain or loss properly allocated to such trade or business. For example, a Section 1231 loss in relation to an abandonment of a leasehold improvement would qualify since this is part of a trade or business. The same would hold true for a Section 1231 gain, which would be determined as part of the trade or business and effectively excluded. We're going to go into what constitutes the entities that would be eligible for this particular deduction. Some of the entities are listed in the slides are as follows. It will be available for sole proprietors. It will be available for partnerships, including LLCs, S corporations, trusts and estates, and certain types of payments. For example, certain REIT dividend payments, that is a portion which is not qualified dividend or capital gain, qualified cooperative dividends, and qualified publicly traded partnership income. Now, what we're going to go through next are going to be the mechanical computations of this deduction. With that, I'd like to turn this over to Michael Benguigui, our Senior Tax Manager with our firm.
Thank you, George. With that, let's go through an example. First, let's figure out what the formula is based on what George just described to us. So the first part of a test, we've got to determine what is qualified business income for each trade or business. So first, it's the lesser of one or two. One is 20% of the taxpayer's qualified business income with respect to that qualified trade or business, or the lesser of one or two, or the greater of the following: 50% of the W-2 wages with respect to that business, or 25% of W-2 wages with respect to that business, plus a 2.5% adjusted basis to the qualified property. I know I've thrown out a lot of jargon out there. We're going to go through further with an example. So that's first part of our test. First, we're going to determine what is QBI at each individual trade or business. Then we have to determine our second part of the test, which is now we've determined all the QBIs, we aggregate them. And then we determine, wait a second, is this all QBIs, is this the lesser of all of the qualified business income, which is calculated, or 20% of the excess of the taxpayer's taxable income over the sum of net capital gains? So then you compare, what is the lesser of those two amounts? The QBI deduction may not exceed the taxpayer's taxable income reduced by net capital gains. Okay, so we just described to you what the formula is. Let's go to an example of a real estate developer. This would probably be a real estate developer out of New York City. Could be anywhere, but this is what we've seen. Real estate developer generates $3 million of rental real estate income from a partnership. The taxpayer owns 30% partnership interest from that development. So the taxpayer's taxable income, excluding net capital gains, is $3 million. The rental real estate income from the partnership is $3 million, which I just mentioned before. His allocable share, 30%, is $900,000. The partnership wages paid by that partnership is $2.8 million. The individual partner shares 30%. That's $800,000 to that partner. The total partnership's unadjusted capital basis is $25 million. Individual partner shares 30% of that, $7.5 million. So let's go through the test. So first we want to figure out what is the lesser of the qualified business income. That's $900,000 times 20%. $900,000 is allocable share of the trade or business income from the rental activity, $800,000, or the greater of, or then we compare the greater of 50% of W-2 wages with respect to that business, $420, or 25% of the W-2 wages less 2.5% of the unadjusted base of the qualified property. So it's 210. Less the 187,500, total is 397,500. So now we're going to look at it and say, okay, which one's the lesser of? That's 180. We take the 180 and we compare that to 20% of $3 million, which is a taxable income excluding net capital gains, 600,000, 180 versus 600. Total QBI is 180.
As we all know, the marginal rate has come down from 2017 to 2018 from 39.6% to effectively 37% beginning this year. The impact of the qualified business income deduction would effectively take income that would be eligible from the appropriate trade or business, including real estate, and we'll define that further, and effectively give rise to the qualified business income deduction, which would effectively create a tax rate at 29.6% for our eligible real estate owner-operated developers.
Now, with that, let's go through a second example. So same fact pattern as we had in example one, but let's say this partner, this taxpayer had a K1, another K1, which generated a net rental loss of $250,000. So how will this affect the QBI for that specific real estate developer? In this instance, the 180 QBI is going to be reduced by $50,000. Why 50,000? Because we're going to take the 250 loss times 20%, which effectively reduces from 180 less 50 to 130. So as you can see, losses need to be included as part of this calculation. Now, let's go through some technical issues here because we've gone through a lot. Now, most real estate developers hold multiple properties in multiple LLC partnerships. We know that, okay? And many times, there's a single management company which receives a management fee from those underlying partnerships. The management company is in charge usually of administrative items in relation to the property and usually pays out the payroll. So here are some of the questions we came up with that we need further guidance or to consider as part of your planning on restructuring this if you want to maximize the deduction. Number one, will the IRS allow in this circumstance a taxpayer to combine W-2 wages amongst the investments, or will the developer have to restructure its holding in which the wages are pushed down to each entity? So do we have the ability to push down the deduction, allocate in a certain specific manner to each partnership? How will the reporting be done? Will this be like the former 199 deduction, Section 199 deduction? If the IRS does allow a combination, how will the apportionment of the C-suite team be done? For example, a CFO, the related employee benefits, would be possible to allocate specifically to each real estate entity? How will this allocation be done? Again, these are questions we don't have the answers for right now for the guidance to be given to us from the IRS or Treasury. If the restructuring is the only possibility, what is some of the unintended consequences? And this is key. From an employment law standpoint, workmen's compensation insurance coverage is usually higher for employers with a significant number of new employees than an employer with a high veteran employment staff. So you can have some unintended consequences when you want to restructure the W-2 wages amongst the different entities. You might have to pay somewhere else a higher fee.
Accordingly, so before we embark with redoing the entire structure for a given client, we need to get guidance from Treasury as to effectively what would be amalgamated through affiliated service group rules, whether it be a pension plan impact, whether it be other payroll impact, to effectively try to maximize deduction. As information becomes available, we will disseminate it to all our clients.
Let's go to another example. So example 3, now we got a similar situation. We're going to use the fact pattern of example number 1. The partner has another K1, and that K1 has a net rental real estate loss of $1 million. How is this going to affect the QBI deduction? So for the year 1, you're going to have QBI from the first activity of $900,000. That's before the 20%. You're going to reduce that by the $1 million, so you have an effective loss of $100,000. Now that loss for QBI purposes gets carried over to the following year. So in the following year, you have QBIA, QBIB, each generating $400,000 of net rental income to that taxpayer. You have to take into account the prior year loss of $100,000. So the total QBI law income for the year 2 would be $700,000 times 20%. The potential deduction is $140,000. So the critical part of that example is that the QBI loss gets carried forward in excess for every following year. Let's talk about some technical issues here for W-2 purposes. For deduction purposes, you have to include W-2 wages. Those are wages that are subject to withholding, elective deferrals, deferred compensation. So all those items are considered W-2 for QBI purposes. What is not W-2 for QBI purposes is any amount which is not properly allocable to the qualified business income. So if it's not part of the deduction to that QBI, it's not included. Any amount which is not properly included in a return filed with the Social Security Administration as well.
All right, so let's summarize for a minute. We've looked at most of the tests, and we can see there's a couple prongs to the test and how we determine the qualified business income deduction, how it's predicated to some extent on payroll, maybe for qualified trade or business, and then the impact effectively is going to have primarily to real estate, which is going to be the capital component that is effectively added to the bill in the last hour. So we certainly want to thank Senator Corker for that. With that, Michael's going to take us through what the capital component is as it relates to this qualified business income deduction and all the machinations that will come by virtue of that. With that, let's go into the capital component.
Right, and this is going to be more prevalent for real estate developers as the law stands right now. So we want to analyze what is the unadjusted basis of qualified property. You get a 2.5%, you have to include that. So basically qualified property is any tangible property which is used as a trade or business and is depreciable. So the key takeaway from there is that land will not qualify for this purpose. Further, there is a look-back period. The property has to be has to be within a depreciable period, which is one of the following. So it has a 10-year look-back. So if it's from 2018, you can look back up to 10 years, so up to 2008 property. The property has to be within the last 10 years placed in service, and the last date in which there is an applicable recovery period for the property which is placed in service. So if it's being depreciated in the current year, then you can include that property as part of this formula. So you got a 10-year look back, or the property is still being depreciated for the current year. And we're going to go through some of the examples and how this calculations come up. So let's go through an example 4. We have here a situation where a developer buys a $30 million land and building in 1997. The recovery life of the building is 39 years. The last year depreciation is 2037. So the first test we're going to look into is it within the last 10 years that's been placed in service. The answer is no, because it's 1997. We're in 2018. And then the second question is it within that applicable recovery period? Meaning, is that building still being depreciated? The answer is yes. Last year depreciation is 2037, so we're okay there. So we can include that $25 million basis as part of qualified property. Land will never be included because it's not depreciable. Then we look into the next items, which are personal property, leasehold improvements of $1.5 million. We do include that. The furniture and equipment of combined amounts of $750, we do combine for the 2018 tax year, and the leasehold improvement of $1 million we do include as well. So the total qualified property base for this example is $28,250,000. We multiply that by 2.5%. That's $706,250. So that would be the amount that we would be using towards the QBI formula.
So, and then what we're going to do is through the series of examples behind this one, effectively sensitize this information so we can show you what would effectively happen if we had different facts and circumstances, which we all do. Again, I want to preface that a lot of these changes are very facts and circumstances specific, and determining this entire amalgamation of deductions and other things that we're going to articulate on today, I strongly suggest everyone contact their Sax their real estate professional or Sax partner to effectively see what impact this will have for their given facts and circumstances. So, Michael, we will go to the next example.
All right. So the next example, similar fact pattern as the previous slide, but now it's 1 year later, we're in 2019. And the critical takeaway here is you'll notice that the furniture and the equipment have been removed from the qualified property base. Why? Because it's beyond the 10-year look back, and it's been fully depreciated. So now, for our purpose, the total amount of qualified property is $27,500,000, and we only get 2.5% of that, so it's $687,500. So you'll notice that from 2018, 2019, there's been a drop. And that's something that we got to keep in mind with when we make these elections. Again, everything that George just mentioned before, it plays off each other. So this is one item that you have to consider when you're coming into the QBI calculation. All right, let's look at example number 5. And example number 5 is basically same as example 4. But let's assume, for example, that the property was placed in service not in 1997, but in 1982. So in 1982, we got the building. It would have been depreciated over 31.5 years. The last year of the depreciation would have been in 2014. And since the last year depreciation is 2014, that property basis of $25 million will not be included as qualified property. So we just lost $25 million in terms of this part of the formula, in terms of this equation. The leasehold improvement would be included. All the other items would be included. But the key takeaway from this example is you have an older property. That older property basis, which could be a significant amount, will not be included because it's either not depreciated anymore, it's been fully written off, or it's beyond the 10-year look-back period.
So what we're trying to illustrate is, again, going back to facts and circumstances. So we show something that was recently placed in service as opposed to something that was placed in service years gone by. As a result of that, we have a rather significant drop-off in the component that will feed into the total qualified business income deduction formula.
Right, and that's a significant amount, George. I mean, we're talking about over $600,000 difference between those two amounts and those two examples. Okay. So you'll see on the next slide that the 2019 example, you take 1 year further, and again, it drops even further because the furniture and equipment has been fully recovered beyond the 10-year look back. So now we're down to $62,500. Again, that's a number that could play a significant impact in terms of a QBI deduction for a real estate developer. So again, a lot of planning needs to go along with this.
All right. So we went through, the better part of all the different components that a real estate owner, operator, developer will be looking at in terms of maximizing the codified 199 capital A qualified business income deduction. One of the other items that will have a significant bearing on real estate owner-operators is the limitation on the deduction of business interest expense, Internal Revenue Code, Section 163J. So generally, the deduction for business interest expense is limited to 30% of adjusted taxable income, which is taxable income or loss before the actual interest expense. That limitation is determined at the entity level. Any disallowed business interest may be carried forward indefinitely. For example, in case of which a flow-through entity is a partnership, any deduction for business interest is considered in determining the taxable income or loss of the partnership at the partnership level. To prevent any double counting, there are special rules that have been provided for determination of the adjusted taxable income of each partner of the partnership, especially where there's a tiered partnership structure. This computation will be adjusted effective year January 1st, 2022. The adjustable taxable income is taxable income loss of the taxpayer computed with regard to any items of income gain, loss, deduction, which is properly allocable to that trade or business, adjusted for depreciation and amortization. A couple of notes. If the partnership were to sell the underlying property, the business interest expense carry forward will be deductible in the year sale. This is the same for an S corporation and its underlying shareholders. If a partner sells its underlying partnership interest, then the suspended share of business interest expense carryover would increase the partner's basis in the partnership interest, thereby reducing the gain or increasing the loss from the disposition of the partnership interest investment. Unfortunately, this does not apply to any S corporations that have effectively an interest in an underlying partnership.
Wow, so George, that rule is not friendly for S corporations at all, and you got to watch, and whoever's selling that S corp interest has to watch out for that if they have a large amount of business interest carryover.
All right, there are some limitations that effectively generally apply to all taxpayers, but there's a carve-out for small businesses with effectively a 3-year look-back to determine whether or not their average gross receipts are $25 million or less and be indexed for inflation going forward. Generally, in the real estate context, when properties are effectively held through multiple entities, there's going to be, and we're waiting the guidance, the application of aggregation rules under the statute, which will effectively deem a lot of our controllable entities as one taxpayer for purposes of measuring this particular test. The business interest deduction limitation does not apply to the following real estate trades of business: real estate property development, redevelopment, construction, reconstruction, conversion, rental, management, leasing, brokerage, or trade of business. The exception applies to real property management companies and lodging facilities. To elect out of the interest deduction limitation, it must be done at the entity level, and I want to add emphasis to the fact that this election will be irrevocable for any future tax year. So effectively, we have to give rise to an analysis to determine what would be more advantageous to any given taxpayer's facts and circumstances. And certainly, we will emphasize to all our clients, this is something that's going to be analyzed over a longer period of time so that effectively an election is made. It's not made in a vacuum and would have any unintended consequences for prospective tax years. The limitation on the deduction, once that election is made, the impact would effectively be the trade-off on depreciation tax benefits. The entity must depreciate the assets that were placed in service in 18 and prospectively using a system known as the alternative depreciation system. So what does that mean in English? Effectively, that means that most of our real estate owner-operator developers recognize what's known as the maker's tables, which feed under the normal general depreciation system. there is an alternative to that process, which effectively changes the lives for the underlying properties that we're depreciating. So in the case of residential, the normal 27.5-year period will convert to 30 years. In the case of non-residential, it will go from 39 years to 40 years. The big impact to this effective process is the impact that they will have no longer have the ability to qualify for bonus depreciation. All right, the next slide will outline the impact from what the class lives would look like under GDS, the General Depreciation System, and the Alternative Depreciation System. Typically, a real estate investment which requires an investment uses mortgage debt. You know, interest rates are a very historical low now, and we might see some increase in interest rates this year. And then use of leverage to purchase real estate is not going to be reduced in the near to short-term future. The planning as to how to effectively utilize depreciation, interest expense deduction, and the overall limitation is done at the individual taxpayer level. So effectively, decisions will be made at partnerships that will impact effectively those partners, including, you know, the managing members all the way through the process. All right, we're going to go into an example and effectively to illustrate what the impact would be, and we have some concrete examples to show how this decision-making is going to be made, again, not in the context of one given tax year, but over a longer period of time. With that, Michael?
Okay. George, thank you for laying out the background. So let's go through an example which describes its limitation of the business interest deduction. Real estate developer purchased a non-residential building for $30 million in 1997. We're going to be using the same fixed asset table we used back in example number 4. Developer's been using the building as part of its trade of business, pays an annual management fee to a related third-party management company. The managing company takes care of the administrative compliance obligations and payrolls of the employees to help service the underlying investments, including this entity. The investment has been held in a partnership which is invested by the individual real estate owners operators. The partners have elected to be real estate professionals. That's from a passive activity law standpoint. The property's adjusted taxable income, which is essentially in this case net operating income before interest expense, in year 1 is $2,800,000. The interest expense is $1,162,500, and the annual depreciation expense for the building, excluding any bonus depreciation, is $641,026. The various personal properties of the balance sheet have either been fully depreciated due to bonus depreciation or the passage of time. So with that as the background, let's see how if one makes the election versus elects out of the business interest deduction limitation, how is this affected? So again, our adjusted taxable income before depreciation expense is $2,800,000. Depreciation expense is $641,026. We have personal property that was placed in service, and in this example, we took bonus depreciation of $1 million. So our total adjusted taxable income before interest is $1,158,974. Now, since we took bonus depreciation, we'd have to look and see, are we eligible? What is the interest expense limitation? Meaning I have to take the $1,158,974 multiplied by 30%, and my total interest expense that are available for this trade of business is $347,692. I could take $1,162,500, but again, I'm limited to only 30%. So my total rental income from this entity is $811,282. Now, if I elect out of the limitation and I want to take the full interest expense deduction, the critical component there is that I can take the deduction, but I can't take bonus depreciation on that personal property. And that personal property, for example, for argument's sake, let's say is qualified improvement property, which we'll describe later. So there, you'll notice that the $1 million deduction is reduced to $50,000. So again, can't take bonus, and I have to use the alternative depreciation system, ADS. So my total net rental income, if I elect it out of the limitation, is $946,464. Now, take a look at what happens from the individual standpoint. If this flows into the individual partner's personal return. The total interest expense carryover, if I'm subject to limitations, 814,808. I then compare it, and then I look at the potential QBI deduction. I take 811,282 multiplied by 20%. That's 162,256. That's lower than the 2.5% for qualified property of 706,250. Essentially, I get the 162,256. Now, you'll notice that if I elect out, my QBI deduction is about 27,000 higher in the example in which I elected out. But again, in that circumstance, I didn't take bonus depreciation, and I have the carryover of the personal property, which I'm depreciating over the next 15 years. Now, if you take a look at the interest expense, now let's look at 2019. 2019, similar fact pattern to 2018, but you'll notice the big drop-off is that the $1 million personal property deduction that I took as bonus is gone. That's been fully written off. My limitation on the interest expense is higher. It went from 347 to 647. And you'll notice that the interest expense when I elect it out, again, still stays at $1,162,500, but I'm only getting to deduct $50,000. The critical item there to note is that the QBI deduction went from $162,256 to $302,256 in the following year. So again, great planning needs to be done when it comes to this. Also note that the unadjusted basis for the qualified property, the 2.5% portion, was not a factor in this circumstance.
We also want to give rise to the fact that the interest expense carryover from one year to the next was increased in the subsequent year to give rise to that. For the illustration in 18, we effectively have 347,000 subject to the limitation. In the subsequent year, it moved to 647 by virtue of the carry forward that was available from 2018 into 2019.
Right. Right. So the total carryover for up to the year 2019 is 1,329,615. Now we're going to use the same as the previous example, but let's say that the property was placed in service in 1982, and the critical takeaway from this example is that the 2.5% of unadjusted basis for the qualified property becomes a factor. We're limited to 81,250 for 2018 and 62,500 for 2019. So now, same fact pattern as before. Our QBI deduction is significantly reduced than before because, again, it's the lesser of 20% of that trade or business, the qualified business income from that trade or business, or the 81,250. So that's the significant takeaway from there. So again, great planning needs to be done in terms of what you would like to do and how these elections interplay against each other.
All right. So as you can see by the illustrations in our examples, this is a bit of a challenging exercise that we're going to have to give great care to managing effectively planning over a period of time. The irrevocable election will have a significant impact as to more or less the type of real estate owner, operator, developer, and what we effectively try to illustrate. For example, if I elect for the 30% limitation, well, maybe I really have low leverage where it doesn't even impact me where I even have to make the election. Maybe I'm a developer that really is more focused on making constant improvements, and I'm relying on depreciation to effectively maximize my deductions and therefore minimize my taxable income. Maybe the property has a high alternative taxable income but low leverage, but no intent to refinance it, and that's key. Maybe the building was placed serves has a long depreciable life, a variety of different factors, improvements that are going to be made over a period of time which the owner-operator is looking to write off. However, now I'm on the other side where I have a highly leveraged portfolio or I'm a fund that is really not focused so much on depreciation, but more focused on the interest expense deduction. The property could be already subject to ADS if it's out of the country. Building maybe has a shorter lifespan, or it could be a triple net lease type of agreement. some emphasis I want to add is this will have a bearing in a lot of family owner operators where we're dealing with multi-generations, and you might have a different result for a older generation as opposed to, you know, the current generation in terms of managed portfolio, and decisions have to be made at the partnership entity level, which will have a bearing as to prospective impact to that given, you know, entity for that particular project. All right. We will now turn to some of the changes in depreciation, which are very favorable with that. Michael?
All right. Thank you, George. So there was some rumors, the House bill, the Senate bill did contain some language in terms of changing the depreciation for residential versus non-residential lives. But in the final conference agreement, the 39 years for commercial and 27 after a year depreciation lives, recovery lives for residential and non-residential had been maintained. However, the lives for residential property has been shortened from 40 to 30 years, as George mentioned before. Bonus depreciation, 100% accelerated depreciation on eligible property placed in service after September 27, 2017 through December 31st, 2022. The critical takeaway is that the original use requirement has been removed, and eligible property is property which is regular depreciable with a life of 20 years or less, same as the previous rule. Section 179, expensing is increased to $1 million, with property placed in service limitation phasing out at $2.5 million.
Let's touch on what we have currently as we're getting into our busy season, Michael. That we want to make sure, as we're meeting with our clients, that effectively that they have projects that they place in service after September 27th to ensure, as you succinctly pointed out, again, no original use requirement. That means used property will now be eligible for 100% bonus depreciation that effectively has been placed in service from September 27, 2017 through the balance of this calendar year.
Right, and the critical takeaway there also is going back to what we just previously mentioned is we have to keep that in mind when we're making that irrevocable election when it comes to business interest deduction limitation.
Agreed.
All right, qualified improvement property. Very similar to the old rules. It eliminates the terms of qualified leasehold improvement, qualified restaurant improvement, qualified retail improvement, and basically it just adds a new term, qualified improvement property. But there is some nuances to this new definition. Improvement to the interior portion of a non-residential building, but eliminates the requirement that it be...
Again, I want to reiterate, can we all please mute our phones? Thank you. All right, Michael.
It further eliminates the requirement that it be subject to a lease and that the building be at least 3 years old. So that's one of the critical differences between the old rule and the new rule. Cost recovery for qualified improvement property is 15 years under GDS, but under the new rules, it's 20 years for ADS. It used to be 39 years.
Effectively, if I'm in a criteria where qualified improvement property applies to me, certainly one of the big takeaways we want to emphasize that improvement will be subject to 100% bonus depreciation.
Exactly.
All right. Just when you think, okay, I've got qualified business income deduction, I've got potential issues to depreciation and business interest expense. On top of all that, now we add in the limitation on excess business loss deduction under 461L. So what does that mean? That means we have a real estate owner, developer, operator with net flow-through losses subject to a limitation of up to $250,000 for an individual, single, and $500,000 for married filing joint. The application of this provision is after, and I emphasize after, the application of the passive activity loss rules. So, real estate developers usually elect to be treated as real estate professional. Under the passive activity rules, would allow them to group their real estate activities, making what would be passive losses into non-passive losses. Those non-passive losses have been available to use and offset against non-passive income. For example, wages, And those excess losses are now subject to, would be carried forward as a net operating loss deduction. Prospectively, those NOL carry-forwards are allowed for any future year to the lesser of the carryover amount or 90% of the taxable income without regard to deductions for the NOL. Excuse me. Consideration needs to be given to the terms of alternative minimum tax NOLs.
So, George, before, if I had a cost tag and I had $1 million, $2 million loss, I could have utilized that entire loss, but now it's only limited to $500,000 of excess business. That's big.
So it will have an impact into how we plan effectively for our real estate owner operators and how they can maximize, for example, the utilization of that loss over that period of time. We need to take great care because, again, this is not something that's done in a vacuum. We have to factor in maximizing the qualified business interest deduction, the impact that might have to leverage regards to interest and then the deduction and the offset on potential loss of depreciation, and then bring it down to the individual level where that loss limitation will apply. All right. Our last topic that we want to touch on as part of tax reform is the impact that the tax reform had to carried interest. Typically, we have a profit interest that's received in a disproportionate share of future profits, depending on a certain hurdle rate, which is effectively known as a carried interest. We're going to touch on it in the context of real estate only. A transfer of a partnership profit interest to a sponsor partner is structured in a tax-deferred manner. Initial receipt of that partnership profit interest is not a taxable event to the recipient to the extent the value is not ascertainable. The new rule needs to be further analyzed in the context in which a real estate investment is held by a partnership entity. Usually a real estate developer, sometimes referred to as a sponsor, has assembled a pool of passive investors, sometimes referred to as limited partners or members, to invest into a fund structure. Sponsors typically invest very little of their personal of the limited partners who are the main investors. The sponsors are usually compensated for their efforts in the following manner. Usually they receive an annual management fee, and then they receive a future profit interest based on the sale of the real estate asset. The profits interest entitles the sponsor to a portion of the cash that the fund receives either from sale or refinancing of the underlying properties. The profit interest is achieved once a specified internal rate of return is met. Since the underlying asset being sold is held for the rental trade or business, the gain from the sale would be taxed at the 1231 taxable rate, which is effectively treating it as a long-term capital gain rate of 20%. Once the sponsor receives the cash in relation to profit interest, as we discussed, the cash is taxed at that rate, 1231 gain. The new law requires a minimal holding period of 3 years in relation to this quote-unquote carried interest. The old law was effectively 1 year, so the impact to our industry will be, being more sensitive to how we monetize the hurdle rate and relative to macro conditions in the marketplace. The holding period starts, in our case, when the partner is granted the applicable partnership interest and starts performing services related to the applicable trade or business, which includes the initial phase of raising capital for the underlying fund structure. The term applicable trade or business means any activity conducted on a regular, continuous, and substantial basis, regardless of whether the activity is conducted in one or more entities. Now, based on the language, one can infer that the holding period for a real estate sponsor is based upon the holding of the partnership interest for at least 3 years and not the underlying real estate investment attributable to that. Accordingly, the carried interest held by a sponsor prior to the enactment date, January 1st, 2018, January 1st, 2018, which is the effective date, sorry, the enactment date was December, would be subject to a 3-year holding period requirement. And there are no grandfather exceptions with respect to this partnership interest. So, that leads us to the impact to existing carried interests that are in place as of 12/31/2017, and the impact to what will happen prospectively with new carried interests associated with projects. With that, we've got a couple of examples that Michael is going to take us through.
Okay, thank you, George. All right, so example number one, the profits interest is determined based on the performance all real estate investments held by the fund. So we have a new fund, and the performance of those investments is based on all the investments of the underlying fund. The fund, real estate sponsor creates a new fund on January 1st, 2014. And on the same date, all investors and sponsor agree that the sponsor should receive a 20% carried interest of all future profits based on a specified hurdle rate. Again, this is based on the performance of all the real estate investments held by the fund. So a carried interest is issued by the fund. It only becomes crystallized once it meets a certain hurdle, and that hurdle is based on all the investments of the fund. Since its inception, the sponsor has been on a regular and continuous basis in the business of buying and selling real estate assets for investment and generating profits to its investors. The fund issues capital and profits interest to all partners on the same date of formation. So that would be January 1st, 2014. The profits interest is determined based on the performance of all real estate investments held by the fund. The fund sold one of its underlying real estate investments on January 31st, 2018, which was purchased 18 months prior to the sale, generating a large amount of gain, a portion of which will be distributed as a profits interest to the partners. So in this instance, even though the real estate asset itself was held for less than 3 years, without any sort of further guidance from the IRS, the Section 1231 gain would be taxed as capital gain to the sponsor because the sponsor held the profits interest to the fund, that partnership interest, longer than 3 years. Again, in this circumstance, it's based on the fact that the profits interest was based on the underlying performance, on the overlying performance of the entire fund, and not just specifically to the asset itself. Now let's contrast that example to example number two. Real estate sponsor creates separate investment pools for each real estate investment held in a partnership format. In each real estate investment, there is a separate private placement memorandum, and the performance of one investment has no bearing on the performance of another investment in terms of how the profits interest will be allocated. So this is basically a deal-by-deal circumstance in which profits interest is from one deal has no bearing on the other deal. However, the sponsor uses one incentive vehicle, partnership entity, that is entitled to the profits interest for each deal, which was formed on January 1st, 2014. The sponsor has been on a regular and continuous basis of buying and selling real estate for investment and rental use. Further, assume that one of the investments was sold in 2018, which was held for less than 3 years, generating a profits interest to the sponsor in relation to that asset. Would such gain be taxed as long-term or short-term capital gain? Now, that sale, more than 18 months, 1231 gain, that Section 1231 gain be allocated to the sponsor, and that's his portion of the profits interest, the carried interest. Without further guidance from the IRS, more likely than not, the profits interest would be taxed as short-term capital gains, since the underlying partnership that issued the profits interest, vehicle, was held for less than 2 years. So the big takeaway from this example versus the prior example is that this was a deal-by-deal circumstance, versus in the first example, it was the profits interest was based on the performance of the entire fund, and the fund has been longer than 3 years.
Great care needs to be taken in consideration with, prospectively monetizing effectively these carried interests, whether it be on refinance or on disposition, to ensure there are no unintended tax consequences or any traps for the unwary, so that effectively you're not looking at something that would be recharacterized at 20% tax rate to something that would be recharacterized at potentially 37%.
Yes.
All right. So with that, as we outlined earlier, we're more than happy to take any questions that are available. If anybody does have any questions, we appreciate you just type them into the appropriate field box, and as they come in, we'd be happy to respond accordingly. All right, so we do have one question. With the potential rise in interest rates, how could this impact effectively refinancing in future years? Just trying to get a little feel. All right, so I believe the question is pertaining to the irrevocable election regarding the business interest limitation under 163J. So in that particular case, with the rise in interest rates and a lot of our clients looking to potentially lock in long-term money in the future, great care needs to be taken to effectively ensure that no unintended consequences as a result by making that election, which would effectively have a bearing on the limitation of the interest expense deduction. So effectively in this particular case, we need to sit down with our clients to ensure if they do have plans to refinance in the future, that we're maximizing that interest deduction and effectively not subjecting ourselves to any limitation by virtue of that. So the question come in, how do they intend to treat long-term capital gains on the sale of real estate? There's been no change in the tax rates associated with the long-term capital gain rate for a real estate owner, operator, developer is still going to be 20%. Question, are you recommending any restructuring of partnerships at this time to take advantage of the new law? We don't want to make any hasty decisions. Effectively, what we need to do is sit down with our clients and ensure if there is a restructure that we need to put in place to effectively be more tax efficient. We also want to be mindful that it doesn't upset other agreements that are in place and settled. For example, if I got a limited partnership agreement that's already been in place going back many years and the limited partners are effectively used to certain results, we don't want any unintended consequences by virtue of making a restructure that could adversely affect whether it be the relationship with an investor or the relationship with a lending institution as well. So everything has to be taken into consideration as a whole, the tax impact, the macroeconomic impact, and certainly the property impact as well.
What impact could the elimination of the state and local deductions have in determining my QBI? That's a great question. The state and local deductions have been basically capped for taxpayers who itemize on their personal returns up to $10,000. QBI deduction itself is a deduction after determining adjusted taxable income. So the interplay there would be perhaps AMT.
AMT could be a component, but effectively what people have to recognize, all our rental real estate properties will be able to deduct their property tax.
Yep.
Number one. If there's individuals out there who are contemplating maybe converting a vacation home to, for example, a rental property, and they meet the criteria, they'll be able to allocate or deduct those property taxes as part of their rental income, for example. But the impact to the QBI would not be effectively, there'd be no impact by virtue of the elimination of the state and local tax deduction, short of some interplay that Mike alluded to in determining the alternative minimum tax. All right, if there are no more questions, what we'd like to do is also point you to our upcoming webinars that we have scheduled, and certainly invite all of you to participate in between the next several months, and including entity restructuring, January 31st, net operating loss for non-C corporations and individual tax update, February 7th, qualified business income, which Michael and I will be giving on February 15th, interest expenses, compensation, and benefits on March 1st, and last but not least, cost recovery and depreciation on March 22nd. Again, we'd like to thank everybody participating in our webinar.